Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from First Resource Bancorp, Inc. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with First Resource, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Glenn Marshall, Chief Executive Officer of First Resource Bancorp, Inc., which trades on the OTCQX Best Market under the symbol FRSB. Welcome, Glenn.
Thank you, Matt, and welcome to First Resource Bancorp's Virtual Investor Conference, March 22nd, 2023. I'm Glenn Marshall, CEO, and I'll be joined today by our President, Chief Financial Officer, and co-founder of the bank, Lauren Rinaldi. Let's take a quick look at our forward-looking statement. Thank you. A little bit about First Resource Bank for the viewers that don't know the bank or are new to the broadcast. First Resource Bank started in 2005 by a group of area business people, Lauren and myself. We wanted to serve Chester County and the suburban Philadelphia market. We just didn't want to have every other bank, so we structured our products to be simple and streamlined without fees. We thought that would appeal to the small business community and give us a marketing edge against middle and larger market banks. In our world, branches are billboards on major highways and not hidden away in a shopping center. We think that every branch needs to get to $100 million in 5 or 6 years to demonstrate that we put it in the right place. We always planned a limited number of branches, and we operated for the first half of our life with just one location. We have 3 now. We consider ourselves to be a hybrid community bank, and I'll talk about that in a later slide. We formed a holding company, First Resource Bancorp, in 2022, and Lauren will have some comments in her presentation about that. The management team is a combination of industry experience and institutional experience. We have 30 years of experience in the industry as a group and 13 on average as a group with the bank. One of the things that we really think and hold as one of our base things is that good to great reference gets smart people on the bus. We think if we can get the smartest people out there, that they're going to evolve, they're going to change, they're going to evolve in their existing role, or they might evolve into a different role. One of those examples is Bridget Moran has taken on the responsibility as Chief Operating Officer at the beginning of the year, which gave us a wonderful opportunity to let our risk function evolve and mature into a full-time role with Natalie Carosa taking that on. So we think smart people will solve problems and they'll solve them faster. I guess every good presentation needs to have a map. This is ours. When you look at this map, we tried to get a little bit of Delaware in there and a little bit of New Jersey so you get a sense of where we were relative to Philadelphia. The dollar signs are our branches, Exton, Westchester, and Wayne. And those branches form a triangle that's $17 billion in deposits. We really don't limit ourselves to that triangle. We really think our physical market area is within an hour's drive from Exton. But we also don't limit ourselves there because of remote deposit and mobile banking. We have remote deposit machines that are a couple of 3 hours away from Exton in our present configuration. So what's a hybrid community bank? We fundamentally believe and have from day one that customers want to talk to a banker. Whether that banker be a phone call, a video call, a security email, or just talking to me in the parking lot on Monday. I talked to 2 or 3 customers. I never even got in the bank. I wound up talking to folks in the parking lot for a long time. But at the root of that high touch premise is people want to talk to a banker. Got to have all the technology. There's no doubt about that. We have to be competitive with the national players, and that's really the high touch part of it. You can see our statement there. We don't think you need to be on every corner. You don't need to have a branch on every corner, but you got to be available with the technology every minute of every day. So I'm going to turn it over to Lauren. She's going to talk about technology.
Thanks, Glenn. Good morning, and thank you for joining us. From day one, we've utilized proven, cost-effective solutions to offer competitive technology. We're not trying to create our own proprietary technology, and we're not taking financial bets that we can build a better mousetrap. We completed a massive core system conversion in July of 2021, which is the equivalent of a brain transplant for a bank. Now that this core processing system has been upgraded, we have a greater capacity to add far better bells and whistles technology that our original core could not allow. In January 2022, we upgraded our digital banking platform, and we have a planned business cash management upgrade to follow, pending availability from our vendor. We're currently operational with iPads with our outbound deposit sales force to open accounts directly at a customer site, eliminating a barrier of entry to bank with us. We are very bullish on this technology as it is the most customer-friendly option, particularly for business accounts, which has been our focus. 2022 was a record year in a lot of ways. We had record net income of $5.6 million for the year ended December 31, 2022, which was 35% higher than 2021 full year results. At year end, total assets exceeded $500 million for the first time at a quarter end, with total assets of $517 million at December 31, 2022. This record growth in profitability and assets generated a record return on assets of 1.17% and a record return on equity of 14.91%. These returns were aided by an efficiency ratio of 58% as compared to 65% in the prior year. We're going to dive into each of these milestones in detail over the next few slides. A picture is worth 1,000 words, and this chart illustrates the fact that we are a growth story. We've had consistent growth over the past 10 years, with a real acceleration of that growth over the past 3 years in particular. Our participation in the Paycheck Protection Program, referred to as PPP, provided us opportunities that we may not have had otherwise. Assets grew $48 million, or 10%, from $469 million at December 31, 2021, to $517 million at December 31, 2022. Over the years, balance sheet growth has been driven by loans some years and deposits some years, but 2022 asset growth was clearly fueled by organic loan growth. To place this growth in context, the first year shown on this chart was 2013, where total assets were only $166 million, and total assets have grown 212% in the 10 years since then. Moving on to loan growth. Our legal lending limit was just over $7.5 million at year end, as compared to just under $2 million when we first opened in 2005. Our loan growth has been aided by this, as a higher legal lending limit allows us to better compete for A credits, which tend to be larger deals. Loan growth has been robust for the past 10 years, even when excluding PPP loans, as we have done with this chart. All of this loan growth was organic, aided by some participations purchased from other community banks, but there have been no loan pool purchases to date. Every loan we have on our books has been fully underwritten by our lending and credit teams. Total loans, excluding PPP loans, grew 19% in 2022, from $385 million at December 31, 2021, to $459 million at December 31, 2022. While loan growth was achieved in all categories of loans, commercial real estate loan growth led all categories, with net growth of $52 million, or 17%. The commercial construction loan portfolio grew 58% in 2022, and a good portion of those construction loans are expected to move to permanent financing within the bank once the construction phase is complete. Despite our significant growth, our geographic reach has been fairly consistent. In general, our loans are all within an hour to 90-minute drive from our headquarters here in Exton. As of December 31, 2022, 93% of the loan portfolio was within Pennsylvania, with 4% in Delaware and 3% in New Jersey. The Pennsylvania portion is broken down further as 57% in Chester County, where we are headquartered, 18% in adjacent Montgomery County, 8% in adjacent Delaware County, 3% in Lancaster County, and 3% in Philadelphia County, with the remaining 4% in other local counties. So now let's talk about our loan mix. This next slide shows a breakdown of the loan portfolio at December 31, 2022. We are a business bank, and the vast majority of our loans are commercial in nature. Commercial 1 to 4 family residential loans comprise the largest part of this pie chart at 26%. These loans typically represent investor 1 to 4 family residential loans. We have a large following of customers that buy and renovate homes for their rental portfolio or resale. This has always been a core competency of the bank, and we consider this type of lending as fairly low risk. Commercial real estate owner-occupied makes up 20% of the portfolio. These are loans to business owners who own the building they operate their business from. These owners typically like to have control of their building and the ability to build equity. Less than 1% of the entire loan portfolio is pure suburban multiple-story office space, and all of it is owner-occupied. Therefore, we have little exposure to traditional office space, which can be considered a bit distressed at the moment due to the shift from work from home at many companies who are now downsizing their offices. Commercial real estate owner-occupied is also considered a low-risk portfolio due to the owner-occupant. Commercial real estate non-owner-occupied makes up 19% of the portfolio. We do not have many office buildings or shopping centers, but we do have a fair amount of space that is industrial flex space, typically below 15,000 square feet in total. These loans may also be mixed-use properties with 1,000 or so square feet of office or retail on the first floor, with up to 4 residential units above that. When we were growing years ago, we didn't have the legal lending limit to do the large type of loans in this area that could be potential problems now. Multifamily is up next at 14% of the portfolio. The vast majority of these loans are in Pennsylvania, with 1 deal in New Jersey and 2 in Delaware. There has been a fair amount of growth in this category in the past few years, as we had the ability to add loans in an area where we typically didn't have a lot of exposure. In the past, these loans had typically been 5 to 15 unit apartments, but we've had opportunities to participate in larger projects with fellow community banks as our legal lending limit has grown. C&I loans represent 9% of total loans. These loans are typically working capital lines of credit, term loans for equipment, or any other credit needs related to a business owner and the operation of their business. Construction loans make up 8% of our portfolio. Typically, these are rehabs going into the commercial 1 to 4 family residential portfolio to be rented or sold. We cater to spot lot builders who build less than 10 houses a year for sale, as well as construction of commercial buildings likely headed to the commercial real estate non-owner occupied portfolio. These construction loans are feeding the CRE portfolio in general. As this construction portfolio churns and the overall portfolio has grown significantly, construction loans have become a smaller portion of the overall portfolio. However, this is a core competency of ours, and we will continue to operate in this space as a trusted lender to local builders. Consumer loans represent only 4% of the loan portfolio, and that portfolio continues to run off. We have no plans to expand into consumer lending at the moment. So now we're going to move on to asset quality. Over the past 10 years, we resolved several legacy problem credits to achieve a nominal level of non-performing assets. In 2022, we generated $274,000 in recoveries, offsetting only $11,000 in charge-offs, resulting in net recoveries of $263,000 for the year. When it comes to collections, we always take the route to minimize the bank's losses, even if it takes a little longer to resolve that way. Non-performing assets to total assets rose from 0% at December 31, 2021 to 0.17% at December 31, 2022. We attribute this small increase to a small number of borrowers that show distress due to bad business decisions as compared to a broader indicator of weakness in the local economy. Moving on next to the investment portfolio. With all the news about investment portfolio valuations in the past week or so, we thought it was important to discuss the First Resource Bank portfolio. The table shown on this slide shows the composition of the investment portfolio at December 31, 2022. At $36 million in book value, the investment portfolio is a relatively small portion of the bank's balance sheet, representing only 7% of total assets at year-end. The U.S. Treasury securities shown on this table are only purchased over year-end for some tax planning strategies, so typically the portfolio is actually much smaller and is rarely as high as 5% of total assets. Back in 2021, when deposits were surging, we resisted the temptation to deploy those funds into bonds, even though we were earning almost nothing on those cash balances at the time. We have always been a loan-driven bank and knew that we would have the loan demand for that cash eventually, and sure enough, we did. Excluding the $15 million in Treasury securities, which matured in the first few days of January 2023, the portfolio is split as $12 million of available for sale securities and $9 million as held to maturity securities. The available for sale portfolio had an unrealized loss of $1.4 million, and the held to maturity portfolio had an unrealized loss of $1 million at year end. As unrealized losses have risen due to rising interest rates, the bond portfolio life has extended, but the average life of the entire portfolio is currently 3.55 years. We firmly believe that First Resource Bank has no intent or need to sell any of these securities for liquidity reasons. Also, the majority of the portfolio are instruments that cash flow. Therefore, we are recapturing a small piece of the portfolio back each month. Our plan is to hold these bonds to maturity, at which point we will recapture these unrealized losses in their entirety. The unrealized losses on the available for sale portfolio are booked on the balance sheet net of tax as a negative equity adjustment known as AOCI, Accumulated Other Comprehensive Income. The growth in unrealized losses in calendar 2022 took 40 cents off of the bank's book value per share. Despite that hit, book value per share grew $1.51 for the full year as our net income more than offset that mark to market on the bond portfolio. The held to maturity portion of the portfolio is not marked to market under the accounting rules. However, the unrealized loss on that portfolio, net of tax, represents less than 2% of total equity. The investment portfolio has not gotten much attention at these presentations in the past, but due to current events, we wanted to discuss it in detail to illustrate how immaterial it is to our overall operations and risk profile. Next, we're going to move on to deposits. Loan growth must be supported by deposit growth, and deposits have grown significantly over the years. Total deposits grew $31 million from $400 million at December 31, 2021 to $431 million at December 31, 2022. Strong growth in money markets and CDs offset a decline in checking. Rising rates in 2022, after many years of incredibly low rates, caused many depositors to shift funds to interest-bearing accounts for obvious reasons. As mentioned earlier, we are a business bank, and our deposits reflect that, with 87% of our checking deposits being business accounts. We are able to compete effectively on business deposits, as so many of our peers charge excessive fees to these customers while also delivering subpar service. The First Resource Bank customer service experience, on top of virtually no fees, has proven to be a win-win combination for us and our customers. Money market and CD balances tend to be more evenly split between business and consumer deposits. We have worked extremely hard as a bank to improve our funding mix by increasing the percentage of checking deposits to total deposits over the years. The yellow line shows that ratio over the past 10 years. From 2013 through 2021, tremendous progress was made as noted on this chart. While 2022 had a decline in checking deposits, we have a robust deposit pipeline and additional dedicated deposit business development staff on board to help us continue to grow checking balances. Another headline of late is the level of uninsured deposits in banks. As of February 28, 2023, approximately 75% of our deposits are fully insured. This is a relatively high level of insured deposits, and our customer base has been resilient despite the headlines. So top line revenue growth. Total annual revenues topped $20 million for the first time in 2022, reaching $20.7 million for the year ended December 31, 2022, as compared to $18.2 million for 2021. Higher interest rates certainly helped the growth in this chart, but the importance of growing the top line is a priority for us, which makes this chart important to the overall presentation. Moving on to the margin. This slide has a lot going on, I'll be the first to admit it, but it really tells the story that no matter the rate environment, we have managed the balance sheet to achieve a net interest margin consistently higher than our peer group. The blue line shows the First Resource Bank net interest margin, while the red line shows the peer group margin. For 2013 through 2018, the peer group was Pennsylvania banks with assets from $100 million to $300 million. And for 2019 through 2022, the peer group was Pennsylvania banks with assets from $100 million to $1 billion. The left axis shows the First Resource Bank and peer group margins. The yellow line shows the average federal funds effective rate using the right axis of this chart. The past year has been a straight line up as the Federal Reserve tightens to try to get inflation under control. While deposit rate pressure has definitely increased, we've managed to maintain a net interest margin well in excess of our peer groups, even when the peer group changed, comparing us to much larger banks. This is another favorite slide of ours. It's a slide we've used since our very first annual shareholders meeting, as it has been of critical importance to us since day one. Our business model of maintaining a low physical branch count, coupled with an investment in proven cost-effective technology, has allowed us to hire the best bankers out there to provide excellent service to our customers and still maintain a lower overhead than our peers. The peer groups on this slide are the same as the previous slide. This unique combination allows us to deliver the technology that customers expect, with access to a team of top-notch bankers to support our hybrid community bank model that Glenn described earlier. It all boils down to net income. The results of our balance sheet growth and maintenance of the net interest margin, coupled with strong expense controls, has yielded the 12th consecutive year of record profitability for our shareholders. Net income for 2022 was $5.6 million as compared to $4.2 million in the prior year. The last few years were really fueled by balance sheet growth and with short-term PPP income more than made up with income from organic loan growth. When comparing the last few years of net income, keep in mind that 2020 included $1.1 million in PPP fees, 2021 included $1.7 million in PPP fees, and 2022 only included $169,000 in PPP fees. Those are all gone now. Replacing those one-time PPP fees and surpassing the 2020 and 2021 annual net income numbers in 2022 was a tall ask, and our focus on prudent growth was key to achieving that goal. A few comments on capital. Another major accomplishment in 2022 was the formation of our holding company, First Resource Bancorp. We had debated opening a holding company for many years, and the extra income we generated from PPP allowed us to take on the one-time expenses of creating the holding company in late 21 and early 22. Having the holding company in place now provides us with enhanced capital options in the future. We can now issue debt at the holding company, which could be downstreamed as a common stock investment in First Resource Bank to support its growth in the future. By issuing debt at the holding company, we can limit and or delay the issuance of new common shares to minimize the ownership dilution to existing common shareholders. We have no plans to issue debt in the near term, but when the time comes, we will benefit from having this holding company structure already in place. Another item to note is that there have been 8 5% stock dividends issued since 2005. An original $10 per share investor at the bank's opening in 2005 now carries a cost basis of approximately $6.77 per share. And now I'm going to hand the presentation back to Glenn.
Thank you, Lauren. Book value. We grew book value in every year that's on this chart. We continue to be very focused on book value. We know that we can control that, all of our various decisions, and Lauren talked about all the pushes and pulls in the recent book value, but we've continued to grow book value in 21, 22, and then through February of 23. I'm not sure everybody can say that. We're thrilled to be able to say it. We always say we can't necessarily control all the things going on in the market with the banking industry and the flows, but we actually love the fact that in the last 4 years that the market has started to catch up and recognize the growing book value and our performance has a value in the market value. And you can see we closed that gap with the market to book. The yellow line is that ratio. When you look at the stock performance, we updated this through the 16th. A lot of mayhem going on in bank stocks in the last 2 or 3 weeks. All of the indices that are on here are negative. The bank is not. The bank has a 11% year-over-year gain, and that separation goes back to May. We separate ourselves from those indices and has consistently run ahead of those indices no matter what was going on in the news or in the markets. We still think that the bank stock FRSB is a value. We think it's a good, if you're adding to your position, great. If you're taking a position, that'd be wonderful. We think there's upside, and we definitely think there's value in our stock. Let's talk about culture. Culture to us is literally everything. It's the jet fuel that drives the plane. Engaged, happy employees help our projects get done faster and more efficiently. It creates that vibe in the branch for our customers, and they get the feel of it, and they bring other customers to us. The awards that are on the bottom there, best places to work, Philadelphia Magazine. And the interesting thing about this award is it's an anonymous survey of our employees. So every year that we've done it, we've definitely learned from it. We've gotten better. These 4 awards in a row have actually been a very good recruiting tool for us to attract other smart people to the institution. And culture is everything to us. And when you want to see the external view of that, best places to bank, best bank in Chester County, for 6 years in a row. This is done by our customers out there taking that quality experience at the bank and wanting just to yell about it, and they vote for us in the Daily Local. And then the question is that process duplicatable? So our branch in Wayne's been open for 3 years or so, and part of that was COVID. Can you duplicate what you do in Chester County and on the main line in Delaware County? And it's a different market for sure. But 2 years in a row, best of the main line. We think that vibe, that culture is translated to the customers, and they've then translated it to this award. All right, contact information here for Lauren and I. We talk to a lot of people, and please feel free to reach out, whether it be about our bank, whether you're an existing shareholder or a prospective shareholder. And we answer a lot. We talked about the industry a lot with folks. So if you want to reach out to us, here's our contact information. We're more than happy to talk to you. And then I'm going to look at Lauren, because Lauren's doing the questions, and she's going to throw them out, and we're going to figure out the answers to them, right?
Yep, we have only a couple of minutes here, but we've got a lot of questions here about deposits and deposit flows over the last 2 weeks in light of everything that's going on. I just wanted to chime in that deposits are up over the last 2 weeks. They're not up exponentially. It's not materially different, really. It's kind of been business as usual for us. Customer base has been very resilient, as I commented earlier, and really kind of business as usual. So, Glenn, I'm going to throw the next one to you. What specifically are your plans to continue the amazing growth and success of the bank? Talking about what you can publicly.
Part of it's about adding resources on the deposit side. I mean, the specific plans, you always got to be careful, getting too detailed. But you had a slide about the deposit mix and the improvements over the 10-year period. And I think that continuing to work on that deposit side, we've added a couple resources there even before this little bit of chaos in the market, because we think the long-term benefit of having a really solid deposit base. Will we ever get to where it's perfect? I don't think so, because we're always going to want to improve it and improve the mix. On the loan side, we have a group of people that perpetually come back to us. We do a really good organic demand. We've added a lender there. And it's a little bit like sticking to your knitting. I don't think what we're doing is broke. I don't see us adding something that's going to add a level of risk that we haven't had in the past.
Okay, I'm going to take another question. Can we speak to our average deposit size? Good question. Our average checking account is $39,000. Our average money market's $125,000, and our average CD is $102,000. So that is good news. What percentage of our loan book is participations from other banks originated loans? That number is less than 7%, but again, we fully underwrote those loans as part of. Oh, we're up on time. Sorry, less than 7%, but we fully underwrote those loans. So I think we need to wrap up.